If you sit across from two different agents this week, one will tell you Indexed Universal Life or IUL is a modern policy and whole life is your grandfather's policy. The other will tell you whole life is the only thing with real guarantees and IUL is a slow motion lawsuit waiting to happen. They can't both be right. They're not even both wrong. They're describing two genuinely different products built on two different promises. And the marketing on both sides has gotten loud enough to drown out the contract. I'm Micah Brown. I sell permanent insurance to people in Michigan when it fits, and I tell people when it doesn't. Today I'm going to draw the comparison the brochures won't draw. By the end, you'll know the four questions that should decide between these two products, not the personality of whichever agent you happen to meet first. What permanent actually means. Permanent life insurance is a category, not a product. The permanent part means coverage that's designed to stay in force for life as long as the policy is funded correctly. Within that, you have whole life, universal life, indexed universal life, and variable universal life. They all promise lifetime coverage. They all build some kind of cash value. They are not interchangeable. Whole life and IUL, the two we're comparing, both build cash value. They both pay a death benefit. They both can stay in force for life. But the way each policy gets there is structurally different. And the difference shows up in three places: who carries the risk, how the cash value grows, and what happens if assumptions don't hold. Whole life insurance. We're going to talk about that next. Whole life is a fixed contract. The premium is set when you buy it. The death benefit is guaranteed. The cash value is going to grow on a guaranteed schedule as well, plus a non-guaranteed dividend if the carrier is a mutual company and decides to pay one. The carrier carries all the investment risk. They make a long-term return assumption, build the policy math behind it, and absorb any swings. You get certainty, but you do give up flexibility. Premiums will be higher than IUL for the same death benefit in most cases. Because you're paying for the guarantees, the carrier has to actually back. Whole life is what a contract looks like when somebody else carries the risk. Next up is IUL or Indexed Universal Life. IUL is structured differently. It's a universal life chassis, flexible premiums, flexible death benefit, with cash value that's credited based on the performance of a stock market index, usually the S&P 500, but carriers are getting new ones in there all the time. The key word is credited. You're not invested in the index, however. You don't own any stocks. The carrier credits your return based on what the index did, subject to a cap, a participation rate, and a floor that's usually zero. A floor of zero means you don't lose cash value when the market drops, minus any policy expenses, of course. The cap means you don't get the full upside when it rises. Participation rate means you might get only part of the index movement to begin with, but also sometimes you might get more. The risk shifts. The carrier isn't promising a return, they're promising a structure. Within that structure, your cash value depends on what the index does and what the carrier's current caps and participation rates are. So this is kind of where an IUL marketing gets loud. A lot of illustrations used to show 8, 9, 10%. That's all changed due to current AG 49 regulations, however. But the gap between the illustration and the contract is where a lot of people still get surprised. The contract gives the carrier the right to adjust caps and participation rates over time. The illustration, however, assumes that today's caps usually last forever, and that's not normally the case. The other cost of insurance inside an IUL, as the cost of insurance increases as you age. If the cash value performance lags what's shown in the illustration for whatever reason, the costs eat the policy from the inside. A well-funded IUL can survive that. An underfunded one cannot. None of this makes IUL bad. It makes it a product that requires honest funding and honest expectations. When it's sold lazily, it can collapse. Sold right, it does what it's supposed to do. So, whole life has its own marketing problems as well. The pitch office often emphasizes the dividend rate of 6% dividend rate every year, paid for over 100 years. That language can sound like a 6% return. It really isn't, though. The dividend rate is applied to a portion of the policy's internal value, not the premium you paid in. The internal rate of return on a whole life policy in the early years is usually negative, sometimes for the first 8 to 12 years. After that, it turns positive and climbs towards something in the 3 to 5% range over a long enough holding period. That's not bad. It's just not what the dividend rate sounds like. Whole life is a long duration product. Sold to someone who will surrender it in year 4, it's a disaster. When it's held for life, it does its job. Here's 4 questions to decide which one's right for you. Number 1, how long will you going to hold this policy? Less than 15 years? Neither one's the answer for you. You probably want term insurance plus a different savings vehicle. 2, what carries the risk for you emotionally? Some people sleep better with a fixed contract and lower expected returns. Others can tolerate variability or higher potential growth. Neither answer is wrong here. You just have to pick the policy that's matched best for how you're wired. Number 3, how confident is your income stream? IUL needs adequate funding for decades. If your income is volatile, the flexible premium structure of an IUL can also be a trap, not a feature. If you skip premiums, the policy still has costs, and the cash value drains. Number 4, what's your actual goal? Death benefit for a legacy is one goal. Cash value access for retirement income is another. The 2 goals point to different policy designs, not just different products. When an IUL makes sense. So, IUL tends to make sense when you have a long horizon and you can fund it well, and you want tax advantage growth potential with downside protection inside the insurance chassis. It works for people who understand that the floor and the cap are the deal, not the illustration. It works for people whose income is stable enough to fund consistently for years and who don't need every dollar back next year. It does not work for people who were sold an illustration without being shown the guaranteed column. The guaranteed column is the floor under the entire policy. If the guaranteed numbers don't work, the non-guaranteed numbers don't matter. When whole life makes sense. Whole life tends to make sense when certainty matters more than upside. It fits people who want to know exactly what the cash value will be in year 10, year 20, year 30. It fits estate planning where the death benefit needs to be guaranteed and the policy needs to stand up to scrutiny decades from now. It fits people who fund a policy consistently for life and don't want the math to depend on what an index does between now and when you pass away. It does not fit people who abandon it on year 5. The math punishes early surrender by design. Neither product is the answer. The question is the answer. How long are you going to hold it? What's your risk tolerance? How stable is your income? And what are your goals? You have to know the 4 questions and be able to answer them. The product will follow those questions. I put together a 1-page decision guide that walks through term versus whole life versus IUL in plain language, and the 4 questions and what each answer points to. It's free. DM me the word permanent on Instagram and I'll send it over. If this was useful, the next video is on annuities, where they make sense, where they don't. Same approach, same honesty. See you there.